Okay, good evening, everyone. Welcome to this options, basics, and strategies class. Thank you very much to ADEX and company for hosting me or allowing me to host this or asking me, whatever. Happy to help out. How about that? So before we get started, have to go through the regular disclosures. I am not a licensed financial advisor anymore. I was years ago. I no longer do that as my primary job function. So do your own due diligence. Anything that I share here, if you're not sure about it, feel free to reach out, especially when we get into some of the more complicated option strategies. You can get yourself into a lot of trouble if you start messing around with the different legs of the spread, for example, which I will, of course, explain what that means shortly. But just be careful. Make sure you understand what you're doing before you start doing it, whether you have to paper trade it, practice it, model it, whatever the case might be. Just please, please, please be very careful. I'll share a few stories of things that happened to myself or, people that I know, other traders, etc. It can be very, very detrimental to not only your financial health, but to your mental and emotional health as well if you take some pretty nasty losses from things that can be prevented. Okay. So this is my Twitter. If you guys want to follow me, great. You can find me there. A little bit about myself. Don't want to go too far in depth into it. This makes me seem like I'm a lot smarter than I really am. I built a career off of easy marks and lots of exams. So if I can do it, you can do it. How about that? I do have numerous financial industry designations, 4 in total, working towards 2 others. The 2 main ones that you need to know about are the CFP and the CMT, so the Certified Financial Planner and the Chartered Market Technician. So I'm part of the, well, I guess now it's called the CMT Association. When I got my CMT, we were in the 1700s, so less than 2,500 in total now worldwide for the Chartered Market Technician designation. I've been teaching at a college since 2010. I've taught a wide variety of courses, family financial planning, retirement planning, tax planning, strategic plan, investment planning, personal wealth management, so on and so forth. So most of my teaching career, at least the earlier part of my teaching career, was teaching future CFP candidates. And then most recently for the last few years, I've been teaching the licensing course, so the Canadian Securities course for future licensed financial advisors. So my students would, at some point end up getting a license and working in a financial institution, mutual fund company, et cetera, giving financial advice with an actual license. So very fortunate to have been doing that. Wasn't that I was super qualified. It was, literally the right place at the right time, knowing the right person. And I can share that story at a later date. Also working on I'm enrolled in the CFA program. I haven't written any of the exams for quite some time. Also pursuing what's called the Trust and Estate Practitioner designation. And right now, my full-time job is I do high net worth financial planning at a family office. So one of the largest family offices in the country, doctors, lawyers, business owners, professional athletes. I even did a plan once for an astronaut, which is like super cool. It's probably the coolest type of profession I've done a plan for. So enough about that. Let's get into the basics of the options. Okay, so I can't responsibly go into teaching option strategies if I haven't at least laid the foundation. I'm sure many of you or most of you already know this, but it never hurts to review the basics. If you want to be a master, you have to master the basics. Okay, so again, as I said before, it is absolutely imperative that you know and understand how options work. If you don't, you will almost certainly lose money. Okay. Things can go wrong. I don't know if you've ever read Mark Douglas's Trading in the Zone, but one of his truths about the market is that anything can happen. And we've seen that anything can happen, whether it be, the market going up 10% in one day, going down 10% in one day, oil going negative, global pandemics, inverted yield curves, you name it, we've probably seen it. And if we haven't, we probably will at some point in the future. So anything can happen. Make sure you know and understand the risks of anything you're doing. So what is an option? Simply, it's a contract between a buyer. So if you are long, you are a buyer, or if you're a buyer, you're long, I should say, and a seller. So if you are selling options, then you would be short. That gives the rights, but not the obligation to the buyer to buy or sell a specified amount of an underlying asset at a specific price before a specific time. The strike price or the exercise price, the price at which the underlying asset can be bought or sold in the future. So this is agreed upon between the buyer and the seller upon entering into that options contract. Now, for the most part, the types of options that 99.999% of us will be trading will be standardized options. Okay, so we're not getting into any sort of customized forwards or anything like that. It's basically just, exchange traded options or futures or options on futures, whatever the case might be. Expiration date, so it's the day that the options expire. Monthly options expire on the third Friday of the month. So technically it's a Saturday, but whatever. Important to note, it doesn't really apply to us here, but if you're over in Europe, there are European style options where you can exercise only on the date of expiry. North American style options that most of us trade can be exercised at any time and without notice. I know it's happened to me before. Trading unit, so again, depends on what you are trading. For stocks, it's 100 shares. For futures, it could be ounces, barrels, bushels, dollar amounts, whatever. And then the premium is quoted per unit. LEAPs, long-term equity anticipation securities, fancy name for long-term options. Calls gives you the right to buy the underlying. Puts gives you the right to sell the underlying. Opening transactions, so when a new position is opened, it will increase the open interest by 1. When that position is closed, it will decrease open interest by 1. And then in the money, out of the money, at the money, I think most of you already know this, so we won't spend too much time on it. Basically, if the strike price is above the current market price for calls or below the current market price for puts, it would be considered out of the money. So if Apple's trading at, we'll call it 130, if you're buying calls, anything above the 130 strike price would be out of the money. The closest strike price would be at the money, and the anything that's under 130 for a strike price on the call side would be considered in the money. And the exact opposite for puts. Okay, because I think most of us know how puts work. The options price made up of the intrinsic and extrinsic value. This is very important to know and understand, especially when you start trading, in the money options. You get into things like debit spreads. You start writing premium, for example, down the road. This really matters. Okay, and we'll talk about that in a little bit. So intrinsic value is how much real value the option has. So if XYZ stock is trading at $100 and a call on the stock has a strike price of 90, then that would have $10 of real or intrinsic value. Okay. No matter what, at expiry, if you have the $90 strike price and the stock's trading at 100, your option will be worth $10 per contract. Extrinsic value is basically time value, but it's not just made up of time value. We're not going to really get deep into the Black-Scholes options pricing model, but there are other factors that tie into extrinsic value, which we'll talk about, the 4 horsemen of the options, so the options Greeks, in just a sec. So all at the money and out of the money options are made up of extrinsic value or time value. Assignment. So when the holder exercises an option, if you've been assigned, you know what that is. If you haven't, you're in for a surprise. Years ago, I remember I had a debit spread. So I was long a call and short a higher strike call. So, let's just say I had the 145 call that I was long and I was short the 150. And, JP Morgan went up above 150 and they exercised me on that short call. And, I look at my account and all of a sudden I'm holding, a rather large short position of, I think it was like $250,000. And it was not pleasant. Fortunately, I had the underlying call to offset it. Otherwise, it would have been in quite a lot of trouble. Okay, and if you're interested in looking up the different terms or definitions, you can find it here at optionstrading.org/glossary. Okay, so the Greeks, simply put, we're not going to get into the nitty-gritty details. I don't think we need to for the purposes of this class. But you need to understand what the four are. I know Wu and some of the other admins and leaders here do a lot of more in-depth option stuff. So maybe some of this stuff is stuff that you already know or you've taken a class on. But the basics of it are delta, which is the rate of change between the option's price and a $1 change in the underlying. So if an option has a delta of 50, and an increase of $1 in the underlying security should increase the price of the option by 50 cents, all else being equal. Theta or theta, depending on where you are in the world and how you want to pronounce it, is time decay. It's basically the rate of change between the option's price and time. So if an option has a theta of 50 or 50 cents, then the option will lose 50 cents of value for each day. This can be your friend or your enemy, depending on what side of the trade you're on. All right. So, most of us are swing traders, or many of us are swing traders. And so we would have negative theta on our contracts, which means that as long as we hold it, all else being equal, it would lose a little bit of value to time decay on a daily basis, which increases as we approach expiry. If you're a seller of premium, which we'll talk about, something like a covered call or maybe a put credit spread or something like that, it actually works in your favor. So you're positive theta. The great part about it is if you, are selling premium over the weekends or over holidays, etc., anytime the markets are closed, you still collect, or that time decay still impacts your option. So you would be actually positive theta, making money over the weekend. If you're long calls over a weekend or a holiday, that negatively impacts your options price. And so this is why, at least the way I trade, we give ourselves the gift of time when buying contracts. So if you're taking a swing trade based on, a weekly setup, probably not a good idea to be buying, a call that expires on Friday, unless it's part of a strategy that you're putting together. But for the most part, give yourself the gift of time. And the further out you go in time, the less time decay impacts your options premium. I'll give you an example. So think of holding an ice cube in one hand and a hairdryer in the other. And so the ice cube would be your options contract and your time value, and the ice cube would just be, the hairdryer would be time. And so as you approach expiry, you bring the two closer together. And what's going to happen, the closer you get to expiry, or the closer the hairdryer gets to the ice cube, the faster it's going to melt. The same thing applies with your premium, right? So the closer you get to expiry, the faster your option will lose value. And that's sourced from the Options Industry Council. Gamma, basically the rate of change between the options delta and the price. So basically how much delta would change for each dollar increase in the underlying. So if the option has a delta of 50 and a gamma of 10, and the stock increased or decreased by $1, delta would increase by or decrease by 0.10. Gamma is very important, especially when you are pricing out a contract and the stock starts to move in your direction. Gamma and especially Vega will actually benefit you. So vega is one of the most overlooked or misunderstood Greeks. It's the rate of change between the option's value and the underlying asset's implied volatility. So sensitivity to volatility. So what does that mean? If the option has a vega of 0.10, it indicates that the value is expected to change by 10 cents if the IV changes by 1%. And so I took this screenshot a while back just to show the impact of implied volatility on the stock's price. So here we have PayPal was trading at $240.86, up 4.75% on the day. You can see here that a call option with 8 days to expiration was trading at 1040/1070, right? So you could have gotten filled somewhere in between there. And then this is some people's favorite and other people's not so favorite stock, GME, GameStonk. You can see here it was down 31.35% on the day. And the calls for the 240 strike price, 8 days to expiry, we're going close to $100, right? So that's the impact of implied volatility. There were a lot of people that bought calls or even puts and made absolutely no money because when the IV collapsed, their options price lost value. So just as a heads up, right now with VIX being high, and especially if it gets like above 35, for example, I won't buy straight calls or straight puts. If VIX spikes to above 35 or 40, I would buy puts on the VIX, but that's another strategy that we can talk about at another time. And so it's important to understand implied volatility. If you're buying high IV and IV drops, market takes off, IV collapses, goes from 35 down to 25, all else being equal, your options are going to lose value. So you want to watch out for that, especially if you're trading earnings, because the market makers will price in what they anticipate the expected move to be. And so oftentimes you'll see many people buy, Apple options or Tesla options or Nvidia or whatever, right before the close, before the earnings report comes out. The stock still goes up, but they lose money on the trade. Most of the time that's because of IV or the IV crush. Options Alpha has some really good and short videos on different topics. Investopedia is also a really good resource. If you want to get into the nitty gritty of it and you want to read some books, Options is a strategic investment by, one of the godfathers of options, Larry McMillan. I don't even know if he's still alive. He's pretty old. Another one by Sheldon Nattenberg is Option Volatility and Pricing. And so before we get into selling premium, or at least before we start talking about the different strategies, one of which includes selling premium, I need to caution you again. Okay, you'll notice that I like to focus quite a bit on cautioning you on what things can be dangerous. When you sell premium, always make sure you understand the risk. Okay, I cannot stress this enough. In fact, unless you have over $10 million in your portfolio and you absolutely know options inside out, never, ever, 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 ever sell naked calls, okay? I know of a Furu who years ago, when Canada was about to legalize marijuana, thought it was a good idea to sell naked calls on Tilray. For those of you that don't know or remember, Tilray went from $150 up to $300 in a single day. And then coincidentally, this Furu's live trading stream started to have technical difficulties when it showed his portfolio down hundreds of thousands of dollars overnight. So just keep that in mind. The risk is theoretically unlimited. Don't get caught doing something you shouldn't be doing. Okay, so selling premium can be very, very, very dangerous. So that being said, I will switch over to here and I'll ask a question. Okay, so I'll give you a hypothetical scenario. You find $100 on the ground You get a check for $100 from a dividend paying stock that you own. Your grandmother sends you $100 for your birthday. God bless grandma. You sell your old Pokemon cards for $100. I might be dating myself a little bit with Pokemon. If you don't know what that is, Google it. You work and you get paid $100. What's the difference, right? When you go to the store to spend that $100, does it matter how you made it? Now, why am I specifying this, or what's the point of this? There are a lot of professional traders out there that will only trade one setup. Some will only trade one stock, right? If you're in the Strat community, you've probably heard of Arturo Peralta, who trades the Strat using Bookmap and only trades Tesla options. That's it. Doesn't trade anything else. One stock, one setup, and he does very well for himself. Some will also just do covered calls, right? If you've got, say, a retirement account and you can't, sell options, or you can't, you can't trade options. Maybe you can just write covered calls on it. Depending on the type of account, there would be, or maybe, certain restrictions. Some will only do put credit spreads, and I'll explain what that is here in a sec. Some will only do debit spreads. The point here is that you want to make money, okay? So go with what you're most comfortable with and what you're best at. Don't worry about anything else. So if one person's trading one strategy and that strategy doesn't work for you, that's absolutely okay. We are under no obligation as traders to have to trade a certain style, a certain strategy. Do what works for you, all right? So don't worry about what others may think about your particular setup or your particular trading style. So what can you do with options? Pardon the pun, but with options, you have options. You can go long or short a multitude of different ways, each with varying degrees of risk and profit potential. You can use options to buy stocks at a discount. You can generate income. You can protect an underlying position. And of course, you can speculate. So the four basics we already spoke about: delta, so rate of change between the options price and the underlying; the gamma, which is the rate of change of the rate of change; time decay for theta; vega is implied volatility. Another one that maybe will start being a little bit more important again is rho, which is interest rates, but I wouldn't really worry about that right now because rates are still ridiculously low until they raise them and we go back into a recession and start cutting them again. So how do you use an option to buy a stock that you like? Well, first of all, let's look at the different scenarios. You can buy a stock at the market price, right? You like XYZ stock at the price that it's currently trading. You can market order yourself in, but you're at the mercy of whoever's on the other side of the trade and whatever order is up next on the block. Next, you can set a limit order. So say Apple is trading at 131, you want to buy it at 130 for whatever reason. You can set a limit order. If it goes to your price or lower, you would get your order filled. Now here's a cool trick, all right? You can actually get paid to buy a stock that you want at the price that you want it. You may not have known that. So by selling a put, this would be what's called a cash secured put. You would be able to sell a put at the strike price that you want to buy the stock for and collect a premium. If the stock goes to the price that you were looking for, you would likely get exercised, at which case you would then be the proud owner of the stock that you wanted at the price that you wanted it. But there are two things here that you need to know. And just give me a second here. I need to flip over to the next screen so that I can show you. A really cool site. So I don't know if any of you have ever seen this site. This is OptionStrat.com. It is by far the best options modeling software website that I've seen. Unusual Whales is also pretty good now, but this is the best one, right? There's a few others out there: options profit calculator, options analysis. You know, you can use TOS. If you use TOS, actually the analyze tab is pretty good, but this is the best one that I've seen. This is one that I use very often. So with OptionStrat, the beauty of it is that you can just go and build whatever trade it is that you want. So let's say I want to buy, I don't know, I like Cleveland Cliffs as a company. And let's say I want to buy this stock. So you can use the different expirations. You know, just click on whichever one you want, and then you would adjust the strike price. So let's say I wanted to buy it at 17 for July's expiry. And so what that means is that I would have to, if Cleveland Cliffs drops below $17, I would get exercised. And in order to be able to do that, I would get a credit of $109. So I get paid $109 to be able to buy Cleveland Cliffs at $17 a share. But in order to do that, and this is important, you need to have the money available. So if you're going to buy a stock anyways, you should, or I shouldn't say you should, but you can consider using a cash secured put to basically get paid to buy it at $17. Now, here's the thing. If you get paid $109 and you buy it for 17, what happens? Your actual cost drops down to $15.91. So your average cost is actually even lower. So if you're looking to buy a stock, something to consider. The next thing that we have is what's called a covered call. Sorry, got my screens mixed up here. So first of all, let's talk about direction, right? So with the different option strategies, we're not going to get into too many of them today because there's a whole list of them. In terms of direction, so if you're long calls and you're short puts, they're both bullish in nature. If you are short calls and you are long puts, those are both bearish in nature. Okay, so it's important to understand the direction that you're trading, especially when you're either buying or selling. You can very easily buy a call when you mean to buy a put, or sell a call when you mean to sell a put, or sell a call when you mean to buy a call. Anything can happen, so just be very careful. Now, something to talk about, very important whenever we're discussing options. With stocks, they will either go up, down, or sideways. With options, they will either go up, down, or sideways. The difference between the two is that with a stock, you really only have to be right in terms of direction. With options, you have to be right not only in terms of direction, but also distance and time, which is why most options traders that lose money when they're right about the direction, they lose it because either they bought too far out of the money or they didn't buy enough time. So if you're a swing trader, always buy more time than you think you need, right? If you are trading a daily chart and you think that this move is going to happen within the next 10 days, well, buy yourself a couple of extra weeks. Always err on the side of caution because that time value will always have value if you need to sell it, right? So, you know, your move happens, you buy a 30-day option, the move happens in 10 days, you still have the remaining 20 days of time value on that contract. Okay, so just keep that in mind. Very, very important when you're trading options. So the next thing I'll talk about is creating your own dividend. And this is through what's called covered calls. So we'll walk through it again. There's a stock that you like that you want to buy. You can sell a put, buy it at the price that you want, get paid to wait. If you don't get filled on that put that you were selling, you get to keep the premium, and then you can turn around and do it again. But with the dividend, with creating your own dividend with a covered call, if the company is paying a dividend, you obviously collect the dividend as a shareholder. If you want to create an additional dividend, you can sell premium against it. So you would have to own 100 shares of the stock in order to do this. And you have to be willing to accept to let the stock go, and that the stock might go above your short call. Now you can decide if you want to let the stock go or you want to roll the contract. It's a little bit more advanced. You would basically be buying back your initial short call and then selling another one. You need to make sure that it's worth doing. So let's go back to our example here. Right, again, we'll use Cleveland Cliffs as the example. So now let's do a covered call. So let's say that I own 100 shares at $15.91. So hypothetically, I sold that put for $109. I collected the credit. Cleveland Cliffs dropped down under $17. I got exercised and I got assigned, and I now own 100 shares at $15.91. So hopefully everybody's with me so far. So now I can turn around, and let's just go forward in time a little bit. I can turn around and I can sell a call against it. So what am I doing? I'm giving somebody else the right to buy it from me at some point in the future. So anytime between today and August 19th at a predetermined price. So let's say I say, I don't know, the $20 strike price. I would collect $150 in premium. If CLF goes up to $20 or higher, or basically if it's 20.01 or higher, I would be able to sell it at 20. My average cost was $15.91. I would get a credit, an additional credit of $150, like 15 cents a contract. And then my max profit would be $559, which works out to 39% off of a stock and covered call position, with 67 days. That's not bad at all. Now let's think about this for a second. Let's scale this up, right? Let's say you have 1,000 shares and you sell 10 calls against it. Now all of a sudden, that 39% is a little bit more meaningful, right? So how much would it have cost you? $15,910 if you sold 10 puts. And then if you got exercised here, you'd make $5,590. Not a bad deal, right? So something to consider there. If you have a larger portfolio, or even if you're building a portfolio and you want to start putting some money aside to building a stock portfolio, it's a great way to do it. Start off by selling puts with cash that you were already going to use to buy those stocks. And then you can turn around, and if you get exercised on them, you can start selling premium against them that way as well. Now, how would you be able to protect a stock position? You can actually buy the equivalent of an insurance policy on your stock position. So let's say you have a retirement account, or you have a large portfolio and you're concerned about the market continuing to drop and you don't want to move to cash for whatever reason. You can protect your stock position by buying a put on that underlying position. It's called a married put strategy. So as with insurance contracts, you would be able to choose your level of protection. So how would that work? Well, let's go back to OptionStrat and have it show us. All right, so here we are. We now own, hypothetically, 10,000 shares of CLF. We bought it at $15.91. It's now trading at $18.13. And so under our strategies, we would do a married put. I'm trying to find that here on the list. Protected put, there you go. All right, so again, same idea. Let's just stick the same example so it's not complicated. We were long these shares at, we'll call it 15.91. So sold the put at 17, got $1.09, and then we have our married put. So now, as with an insurance policy, we can choose the level of protection that we want for our policy. And so what does that mean? It means that if I own the shares at $15.91, anything under $15.91 would mean that I'm taking a loss on the shares. So we would be able to choose what level of protection we want. So if we said, hey, you know what, I want to be protected for anything, any price drops under 17, you'd be able to buy a policy on that. So it would cost you $171 to buy one contract. If you did it for 10, it costs you $1,710. So it has to be worthwhile to do, but that is an option for you. Now, let's say that you think, okay, this is a little bit more expensive than what I was looking to do. You can do what's called a collar. A collar is where you sell a covered call and you have a married put together. And what that accomplishes is within that certain range, you have your protection and you're financing your married put through the sale of the call. And so let me show you how that would work. Right, so you'd be long 1,000 shares at $15.91. And you would sell, we'll call it the 20 and the 16, right? Just hypothetically. And so what does that mean? It means that you would, okay. So it means that if it goes up to 20 or higher, you'd be capped. If it drops, you take no loss. So imagine being able to do something like that under these market conditions, where you have a stock, you're up on the stock, and you can finance your insurance policy to the downside by selling a call against it. So if it goes up, you still benefit. And if it drops and you didn't want to sell and go to cash for whatever reason, then you would be protected. Okay? So you can finance one side of your trade with the other side. Okay, everybody good so far? So that was the collar. And so now, how would you be able to boost your returns? This is where you would be able to turn a little into a lot. You might hear various groups, so like the Alpha Pack, that's my home base. One of the big sayings there is turn a little into a lot. And so how can we do that? We can do what's called a spread. So a spread, a vertical spread, is what we'll cover today. Primarily is where you are long one strike and then you sell another strike against it. So if it's a call debit spread or a vertical call spread, you would own one strike and you would sell a further out strike. So let's go back to the example here of Cleveland Cliffs, and I will show you exactly what that means and how powerful this can be when you combine it with the strat. Okay, so here we have Cleveland Cliffs. Again, we'll just ignore our previous purchase. We'll just stick with the same ticker. So let's say that for whatever reason, I am bullish on Cleveland Cliffs. I can do one of many things. I can buy the stock. I can sell a put if I think that, it might drop and maybe I want to get exercised on it. So we know what the put looks like already. You can buy a regular or naked covered call. Sorry, just regular covered call. You would just buy a regular call. It's been a long day. I apologize. It's getting late here on in the Eastern time zone. So you buy a call, and if the price goes up, then you would benefit from that price increase. And so for now, let's just say I want to buy the $19 call. So you can actually go through here and see what your option would be worth. If it went to 20, what percentage return would you get? Right? You can just kind of mess around with that there. You can change the implied volatility, the range on the chart, so on and so forth. Okay. And so how would you find a good contract? Well, you can go through and you can choose the different strikes, or, and this is a really cool thing here, you can go to optimize. If you go to optimize, same ticker symbol, let's say that you are very bullish on it, it will give you what the best strike or setup would be for that particular, your particular opinion, I guess, like I could say. So let's say you're willing to risk 500 bucks, right? You can go long call, bull call spread, bull put spread, or a broken wing butterfly. We won't get into that today. We'll talk about butterflies, but we won't get into, broken wings and stuff like that. And so right there, you can see that this would cost you $50. If it gets up to, 23.20, your return on risk would be very high, right? 600 and something %. So you can mess around with the different contracts, the different expiries, whatever. Now, let's say that something's a little bit more expensive, right? And you've got a smaller portfolio, but you still want to take advantage of some bigger names, right? One name that comes to mind is one of ADEX's favorites, Enphase. You can see how even if you're going out, 30 days, an at-the-money call is still pretty expensive, right? 15, almost 1,600 bucks. Well, let's say that, a $1,600 contract is out of your budget, right? Maybe you've got a small portfolio, maybe you've got a large portfolio, but you're not willing to risk, if you've got a $10,000 portfolio, maybe you're not willing to risk, 15% of it on a trade. So what can you do? You can do a spread. And so we would be buying one and selling another. So let's say that we think that it's going to go up to 200 by July 15th, hypothetically speaking. Right? So we can buy the 95 and we can sell the 200. So what does that mean? It means that if it goes above 200, we would be capped in terms of profit, but it now reduces our cost down to only $142. Right? And the further out you go, the higher percentage return you can get. Now, don't get crazy with this and, think, hey, oh, I can get 1,000% if it gets to, 240 by July 15th. There's a few things that you need to take into consideration. First, let's look at what's a stock that's currently in full time frame continuity to the upside. VXX, how about that? Let me just clear all this off. All right, so here's VXX. And let me put this onto the other side. All right, so we can see here that VXX is in full time frame continuity, right, to the upside. And let's just ignore everything else and just stick with the fact that it's in full time frame continuity. And so let's say that I want to go long VXX, and I think that it's going to make a move up to here. Or let's look at the weekly chart, right? Where are some of our targets? Here, 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 maybe all the way up there. Let's just take this one here for the sake of this example. So that's 29.28. How would I structure a trade like that and put a spread on? So a few things that you need to take into consideration. One, your budget. Two, your magnitude. So what's your target? And is it actually realistic within that time frame? Okay, because you can go with, you know, a strike that is expiring Friday, and you know you can get a ridiculous return if it does happen to, you know, get to that strike price. So I'll give you an example here. You can buy the $28.50 $29 spread. So what does that mean? It means the spread is 50 cents wide. So no matter what, at expiry, the entire contract, or sorry, the entire spread cannot be worth more than $50, okay, because there will be no time value. And so if it's 29 or higher, it will max out. Well, this would cost you $6 with the maximum potential return of $44, assuming that on Friday, VXX closes above 29 bucks. Now, in terms of percentage, that's 733%. Not a bad deal. You know, if you do 10 of those, now, of course, you got to be careful. Some of these have pretty wide spreads, so you might have to, you know, pay the bouncer an extra $5 to let you into the club, but you have the example there, right? So if you buy 10 of these, it'll cost you 60. If VXX closes above $29 on Friday, your profit's 440 bucks. It's not a bad deal at all, right? Assuming that we get that spike on VIX. Now, let's say that you don't think that that can happen because we're looking at it weekly. Maybe it's not that realistic. So let's take it out to July. You can see how it now costs you a lot more because of the probabilities and the pricing of those options. So again, same deal. It would cost you 270 if on July 15th it's above 29. The max that contract, or sorry, that spread can be worth is $730. Still 270%. Now, here is something that is very important, okay? With these spreads, unless you are like way deep in the money, in which case you're probably going to get exercised on the short spread, you're not holding these all the way to expiry, okay? This is just a very easy way to reduce your cost and still participate in a move. You are free to hold it as long as you want, as in, you know, the options contracts or the spreads, but just keep in mind that you always want to manage your trade responsibly. Okay, so the most important thing to remember is that anything can happen. So if you buy a spread, right, let's say you get this spread here that we talked about, and if you're up like 300-400% in a day or two, probably a good idea to book your profits, because especially something like VXX, like if we have a market rally, we all know what can happen, right? Where volatility would drop. This, of course, tracks the short-term futures, and you might end up with a losing trade. So it's a great way to A, manage your risk, B, enhance your returns, and C, get some pretty exciting trades on. Now, you can do one more thing, and this is where things can get really interesting. You can do what's called legging into a spread. So let's say I buy this VXX 28.50 call, and it cost me 60 cents, right? Now let's say that VXX goes up, and this is now worth $1. And then I turn around and I sell this one here at 54 cents. So in this, under this assumption, we've bought this underlying call. It's gone up in price. And what we're doing is using it to enhance our returns and also lock in some of those profits. So now if I include this, you can see how the return is enhanced. So you're buying the 28, you're selling this. And so something like that here. So you're long these at $1 and you're selling these at 54 cents. No, sorry, wrong direction. So let's say you bought them at 25 cents. And this is not working out as planned. 0.25. There we go. My brain does work on occasion when I'm sufficiently caffeinated. So let's say you bought this 28.50 call. You're now up on the trade. You're in profit. You want to start locking in some of these profits. What can you do? You can then turn around and sell you can leg into a spread by selling a call. So now you will have a long call where you're in profit, and you have a short call that you're selling to basically lock in some of those gains and also enhance your return. So what ends up happening? If you bought it at 25 cents and you can turn around and sell this for 54 cents, you're locking in a credit. So no matter what happens on that trade, you can't lose money because you got a net credit. So if the price drops, you don't lose anything. If the price goes up, you can still max out at 272%. And so for those of us that trade options, especially when you get into, some longer term plays, you can do what's called a diagonal, right? So again, I'll use the same example. I'll go out to July. I think that it's going to get up to 29 here at my target. But let's say that I don't necessarily want to put the trade on or have that long leg. And so what I can do is what's called a diagonal. A diagonal is the same idea. You're long one call and you're short another call. But now instead of having the same expiration, you have different expirations. So why would you do a diagonal? Again, let's say you've got something that's a little bit more expensive. You want to finance part of that cost by creating a spread. So what can you do? You can buy, now let's use July here as an example. So you can buy whatever, the 25 call, and you can sell a call against it. So what does that mean? It means that I'm long here, or even better, something that I like to do if I'm doing a diagonal, is I might even go in the money because I have less time decay, I have a higher delta, and implied volatility impacts my underlying contract less the further in the money you go. And so I can buy this one here and I can finance it by selling a shorter dated option against it. And so what would happen if this price goes up? Remember, your short leg here would lose value a lot faster than your long call would. So here you would actually end up being potentially theta positive. And so that's one option for you there. The last thing that I'll show you, and then I won't keep you any longer, is what's called a butterfly. Now, before I explain what a butterfly is, I'm going to caution you. You can use a butterfly like a sniper rifle, or you can use it like a hand grenade. Okay, what do I mean by that? First of all, what is a butterfly? A butterfly is basically two spreads in one, right? So you have a credit spread and you have a debit spread, but you have the same strike for the two short legs, all right? And so what does that look like? You would be long a call for a call butterfly. You'd be long a call. You would be short two calls of a higher strike, and then long another call on the other side. For the purposes of this example, we will simply assume that the legs are the same, or sorry, the wings are the same length, right, or the same distance apart. So let's say that I want to do a butterfly around $30, right? And so if we're using July here as our example, I think that by July, this target will be reached. And so if I put on a butterfly, it would cost me $74. And if at expiry, it pegs right at $30, my max profit would be 420. Percentage-wise, that's 572%. But it has to close right at $30 on that date for that to happen. Something like VXX, maybe not the best example. Let me look at, I don't know, Coca-Cola. Right, so same idea. Coke right now at 61.35. I'll just pin it around 65 just for the sake of this example. And so your max profit here, if you peg it at 65, would be 200%. So how can you use it as a sniper rifle? Well, let's say, and I'm just ignoring time frame continuity right now, but let's say right now we're trading at 61, and I think that by expiry it will be at 67. So I can actually set it for the 67.50. And if I go $2.50 wide, remember, the narrower the wings, the lower probability of it pinning there, or being profitable, I should say, but the higher potential percentage return you have. So with something like this, if it does pin at 67.50 on July 15th, your max return off a $23 purchase is basically almost 1,000%. Which is pretty wild. However, keep in mind that if it gets there early, your percent return would not be as high. Now with butterflies, there's a few things that you want to take into consideration. Number one, bid-ask spreads, okay? If you're trading something that doesn't maybe have a lot of liquidity, then you might find yourself in a bit of a bind when you're trying to get into the trade. You might have to pay up for it, and getting out of the trade might be difficult. A point to make about any sort of spread: never, ever, ever sell the long call and keep the shorts on by themselves. Okay? That is a recipe for a disaster. I'll see if I can find the link. Actually, I might have shared it already in the room. But there was an example of a guy who did a put credit spread. So basically what he did was he sold a put, and then he bought a lower strike put. So I'll actually show you what that looks like here. So we'll use Coca-Cola again as an example. Let's say that you don't think Coke is going to go below, I don't know, $60, right? So you can do what's called a put credit spread, where you are selling the closer strike price and you're buying the next strike out, or whatever strikeout that you want, as protection, right? So in this case, it would be $2.50. So the max risk, the max that you would end up owing would potentially be $182. So 250 minus the 68 that you get, your max risk is 182 bucks. You know, if it's a $1 wide spread, then it would be $1. If it's a $5 wide spread, then it would be $5 less whatever credit you received. Well, there was an individual who sold a put credit spread on Tesla, and a $1 wide spread ended up costing this guy $30,000. And there's a little bit more to the story, but basically, you know, he held it to expiry, which I will tell you, unless it's something like a debit spread, right? So you bought one call and you sold a call against it, or if it's like a covered call, or even like a cash secured put, you're okay with holding to expiry. Anything else, I always recommend closing out the trade, right? Never, ever, ever assume that if you plan out a trade, especially when you're with like dealing with spreads, like a butterfly, don't assume that you're going to make that maximum return, okay? It could happen. The probability is very low. And if you decide that you want to maybe just close out part of the spread, you're setting yourself up for some pretty serious, you know, financial and emotional damage if it goes against you. So be careful. So this guy basically sold this credit spread, and he ended up, it ended up costing him $30,000 because he was exercised on one leg. By the time he was notified and found out, it was already too late for him to exercise the in the money spread, or the in the money option that he had. And basically he got cooked. Okay, so anytime you're dealing with spreads, know the risk and just think about what would happen if the worst case scenario was to occur. But I mean, selling options premium can be very profitable. You know, if you've got, you know, $500,000 plus, there's a lot of different things that you can do with generating income from that portfolio. You know, if you've got, you know, 7 figures in your account, I know some traders that, you know, one guy's worth like 100 million. His portfolio is like 10 or 15. You know, he'll sell naked calls on like Tesla or like Amazon. And so sometimes he'll be like, yeah, hey, I made like $500,000 in 2 days selling these options. Other times he'll be like, yeah, I'm down $1.6 million because I sold these options. So, you know, with a larger portfolio, you can take on additional risks, and, you know, you can trade your way out of it. But if you've got a smaller account, you might not be able to survive that. Now, keep in mind that there will be different levels when it comes to options. Okay, so, you know, being able to buy options might be level 1, selling covered calls might be level 2. You might have to take a test. You might have to have a certain dollar amount. You need to figure all of that stuff out for whatever strategy it is that you're looking to do. So back to the butterfly here. If you put on a butterfly, how do you have it basically as a sniper rifle? Like I said, you know, you are looking to get it, you know, as close as you can. How do you have it more as a grenade? Well, you just widen the wings, right? So if I do this $10 wide butterfly on Coca-Cola and it goes up, you know, you can see basically all it has to do is move a little bit for it to be profitable, right? And so it would cost you 237 if, you know, in the next couple of days, it got up to, I don't know, $64, you'd make 159, or percentage wise, 50, 60, 70, 100%. The thing with these is the longer you hold them, the more time decay benefits you. So don't get in today assuming you're getting out tomorrow. That's the wrong strategy. You have to pick the right tool for the right job. But if you're trading, a weekly or a monthly setup, you can definitely, try and pin that using a little bit of money and turn it potentially into a lot more. And then, you can stack them so you can have, a couple of different butterflies on. You can have butterflies in different directions. There's a whole bunch of different things that you can do. But that's it for me in terms of this presentation. Hopefully you all found benefit from it. Does anybody have any questions, comments, concerns, complaints, or donations? Just kidding. If you do, please feel free to type them in. Thank you for attending. You know where to find me if you have questions. And hopefully you found value from this. So I will stop sharing my screen and I will stop the recording. Well, actually, I'll stop sharing my screen, but I'll keep the recording on in case somebody has questions that need to be answered. So there was a question here about a gamma squeeze. Okay, so basically, a gamma squeeze is where the stock price starts to go up really quickly and the market makers need to essentially adjust their positions in order to offset risk, right? So what does that mean for us as investors? You see GameStop or you see like whatever, and you think that, hey, there's going to be this gamma squeeze or whatever. It really, planning, to take advantage of a gamma squeeze happens very rarely. Okay. It does happen, but if you're waiting around for like the MOAS or something like that, I hate to break it to you, it's probably not going to happen, simply because something like AMC's got 516 million shares outstanding. If it goes to $1,000 a share, that's like $51 trillion. The entire market cap of the S&P is 36 trillion. So something like that is not going to happen. But basically it's just where they have to offset a rapid move in the underlying security, right? So the main thing that happened with something like GameStop was that there weren't enough shares. There were a lot of options contracts outstanding. It's really not overly complicated. So hopefully that answers your question. Any other questions? Yeah, so gamma squeeze is basically just the option make the market maker needing to offset their position. Now, if you had like a huge amount of money, you could basically create your own scenarios like that, but that's not really something we're going to talk about here. Okay, so if anybody else has any questions, feel free to hop on the mic. You can unmute yourself, I think. Otherwise, we will call it a night. Going once, going twice. sold. All right, so thank you all for attending. Hopefully you found value from it. You know, if you have any questions, feel free to reach out. Okay, take care, everyone. Have a good night. Bye for now.